Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get cut. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. It is Wednesday and a quite interesting overnight interesting setup for this morning. It is that the right way to say it? I don't know. So I have to apologize. I started quite a bit late today because I was having some network problems, but we sorted it out and everything is cool. So to the charts. Boom. Okay, so in the overnight session, well, I'll show it here in the Treasuries because I think it's more pronounced here in the Treasuries. So overnight, there was news that the UK will probably have to implement Plan B because of the Omicron virus. And Plan B basically involves, hey, if you can work from home, you should work from home. So I think that initially they moved up off of that panic headline, but then you can see here that they just absolutely cratered, and we are now a little bit lower. Now realize when this was the Omicron panic from Black Friday, right? We're still quite a ways away from that, so we could fall quite a bit more, right? We'll look at it in the S&P 500. You can kind of see a similar thing. It kind of dipped, and now we're back up to highs. Pretty bullish action the last 2 days in the S&P 500, though. I want to point out in particular that RTY really outperformed over right here on this. So there's probably some really significant short covering on this move, right? Oh yeah, also some steepening in the yield curve, right? So CB finally giving up a little bit, which kind of makes me question if I really want to be, if we're going to take a second contract, it probably should be over here in CB, yeah? Now oil kind of a similar thing, but oil's doing pretty good, 72.15 right now. Had a pretty good move up yesterday, so maybe taking a break. Natural gas saw a little bit of a spike yesterday and now a little bit higher now. So they might come back and recover this $4. Seems like there's some disruptions going on over there. Yeah. Now gold and silver, they were kind of edging up a little bit, trying to make back that 1800, but no. When I look at things like the news and what's going on in gold and silver, it looks to me like it is mostly hedge funds playing over there, and they're not really being too helpful. So you got that going on over there. And then copper, I think that copper could maybe get back to 4.5 at some point, but for now, pretty quiet, just kind of in the range. Now, the dollar, well, look at this, like wild swings in the euro. So that really tells you, hey, this was the euro. And I think that it was like, I mean, I'm not 100% sure because I didn't get like the headlines and everything, but I think that it was like, oh, Plan B, a panic, everybody panic. Oh, wait, Plan B is not that bad. And, and then we move lower. And Bitcoin's still trying to recover from the, beating that they got over the weekend. Past 24 hours or so worth of action hasn't been helpful for them, but this is just kind of, it's not really doing much of anything. Well, we got a pretty good move there in the Treasuries here on the open. So that's interesting. I'm going to continue to try and manage a long position in the yields. It looks like a pretty strong flattener is coming in, which is working to my advantage. If we get $100, actually we have more than $100 baked into this now. So I am really hopeful that I can hold this until FOMC. And if I can get to FOMC and have like a big old fatty profit, because anybody anybody that's long treasuries here, I think, expecting something dovish to happen at the FOMC meeting is, I think, going to be sorely disappointed, because again, and I've I don't know, like, not everybody's reporting this, but I've been reading some reports that basically say that the internal thinking of the Federal Reserve, and I'm not just talking about like the governors, but like all of the people that do the economic projections and stuff like that, has changed in a significant way. And that change is that they now believe that the risks from further virus outbreaks are inflationary, not deflationary. And that's a big deal, right? Because that means that, hey, even if we have an Omicron panic, they still have to tighten. Well, this is that move, like just watching it here, it didn't seem like a huge deal to me. I mean, it's only like a basis point, but man, on the chart, it looks so ugly, man. Welcome to Day Trader's Paradise, or Investor's Nightmare. Well, but that's the thing. We got to figure this one out, man. This is one of, if I get done with my other projects, so I got two, man. So I have to take a lot of time off before the end of the year. So I'm gonna get like a solid 2-3 weeks to work on this stuff. One of the things that I need to do is I'm going to try and get some machine learning stuff going with TensorFlow. I think I know how to do it. I've got like the basic framework, and I just got to learn how it works. Okay. And I'm hoping that then we can start running J again, and we can have some fun. But I'm also learning statistics. And man, let me tell you what. I'm just getting caught off on tangent after tangent here, right? I started reading my statistics book yesterday. I think I'm going to have to actually get a hard copy of it, because, like working through the problems and everything was pretty, whoa, okay. Even like the first chapter was it was stuff that I kind of vaguely remember learning in school. It had to do with like unions of sets and Bayes equation or whatever it is. Which I feel like I understand a lot better now, but I still don't completely understand it, like why it is the way it is. But I think I can plug numbers into it, It was hard, so I'm going to be doing that over the holiday. But then the other thing that we've got to work out is volatility, because with the way that we trade, volatility is very problematic. Like, yeah, you get a lot of range, but you end up having to take a lot of risk to do it. And eventually what happens is you end up taking on more risk than you can chew. What do you do about that? It's a tough question, because if we're relying on, remember, markets are more statistically efficient than they are informationally efficient, then we're looking to capitalize on informational efficiencies. Well, when the market is going to be most informationally inefficient is when volatility is high, which means that we might not be able to rely on what's supposed to happen actually happening. You get what I mean? Yeah, you can decrease in size, but I guess in this particular in the situation that we were just in, it really came down to me wanting to mess with oil. Yeah. Because if we had just stuck to treasuries, we would have been fine. But, when that sort of thing happens, it kind of seems to me that catching a runner in a micro contract is maybe not the best way to play those. That you need to do something that you can manage your downside risk better. So, like, hence probably why options get more activity when we have high volatility, right? But then the issue that you have is that if you buy options in those situations and volatility decreases, then the value of those options may decrease as well. And so you have that problem. Well, it looks like these treasuries are probably going to recover a little bit here. I don't know if I detected a hole per se down here in the bottom, but it could be there. That's something got to watch for. There is, I think, a flattener going on. So if we are going to flatten and we recover, I would expect the ZB to swing back up here more than the 5-year, but that's not what's happening at the moment. Japanese city pop as the soundtrack in the background. Good. We played around with music, and it seems like, a lot of people on their streams, they use music, but I feel like that it's better that you guys could, you use your own music. Oh, I hate it when they do that. So, like, I'm the only one that's taken a trade in the 5-year. You see that? Like, there's only one contract traded. It was mine. Hey, guess what? I made the right trade. So y'all missed out. Y'all could have been long the 5-year yields. You didn't do it. And now they're like, well, we're not going to fill you. You're going to have to force us to stop through it because we don't want to give up the $10. Okay, that's fine. I might have to what is the word? I might have to compromise here. Oh man, so yeah, Bitfinex has been really active past few days. I guess he gets a high from like when Bitcoin falls, right? And he posted the funniest. I thought it was the funniest tweet yesterday. Was like, where is it? What was it that he said exactly? He said, like, it's a social experiment. Yeah, there we go. Tether is a social science experiment. You run a business that's the easiest business model to audit. We just put cash in a bank account, honest, simple. And then you do everything you possibly can to look like a fraud and see how many idiots you can fool. I love just that's so funny. I love listening to the soothing sound of Seth's voice when I lose my money. What about you guys? I appreciate it. I've been a little self-conscious the past week or so about the quality of the sound on the stream because the noise floor on my sound my sound device isn't, the preamps aren't as good as I probably need to be using this microphone. So I really am boosting the volume in software, and that kind of leads to it being a little airy. When spread is big like that and you have a limit order, isn't there a chance that when the best offer becomes that price and the market moves up, high frequency traders will just pull orders and no one hits? Yes, there is, Kyle, absolutely. I was actually, if you go and you watch yesterday's stream, you will actually see a place where that was happening, where, like, so for instance, here in the 5-year, I'll stop moving. I could put a bid here at like 1.299, and be the best bid, and there be nobody behind me at 298. Yeah. And it could be like you put it at 29, or maybe you do an offer at 299 and they move up, and and it won't be until the best bid is higher than 299 that you get filled, right? And the HFTs in this kind of a situation, I would think, are probably like, yeah, we're not going to fill that or do anything unless we're forced to. And given that very, very aggressive, by the way, move that we had there, is coming back pretty hard, they're going to be like, nope, we're not going to. So yeah, it's going to be hard to get filled at 30.5. They're going to have to be forced to go through me. Like the 5-year is going to have to go to new lows, and the robots say, okay, now it's worth it to me to hit you with a market order to get ourselves back in line with what the yield should be. Yeah, then when your limit order goes to mid price, then some HFT will see edge in hitting it. Well, that's the thing, is like if I put a bid at 290, I don't think they would hit me. The thing though is, part of what's going on here, I think, this is really mean, right? It's like a 4-tick spread. Like, that's excessive even for the 5-year. Why is that? Because I'm the only one that took a trade. So they're like, we have to increase the spread to account for the fact that Seth might know something. Do you see how it works now? You see what I mean when I say that, like, they pull their orders, they pull their liquidity based on the probability of informed trading, based on the order flow and the fills that they receive. And if the order flow is such that they're getting too much buying coming into them, they pull their orders to account for it. And that's how the market making strategies work, because on average, you're going to make money if you just take fills at every price, but not if you're trading against somebody that knows what's going to happen and there's a big move against you. So the market maker has to adjust things to account for that person that might know what's going on. Your vocals sound good. I'm telling you, it doesn't sound as good as like when I do a full video. I would rather it sound like that. Seth is always like, stop using leverage air cages, put down the rope air cages. I love it, but I never listen. Oh. So it was kind of an interesting bounce. Well, the move was interesting. I didn't see, well, okay, so first of all, I don't have financial juice running, so that's the first thing. And then the next thing is that this move was like now almost 20 minutes ago. No, so that was nothing, no news squawks saying anything in that time. So it was really just somebody deciding to come in and take a little spread trade, perhaps. But I think one of the things that's fun about the micros is that you can see that stuff happening in some situations, right? You like, sometimes there's one guy sitting there and it's like, oh, you can tell that he wants out, and you're like, well, I think it's going to go up and I'm willing to hold it for a while. Why? And we'll fill you, and I take it. It's great. And then when there's only one, you're catching the edge. It's great. Yeah, it also happens in liquid market. What changes is density. Thick markets open spreads, but thinner markets will have the immediate price range thinner. Yep, exactly. Well, I mean, in the 10-year, generally what you'll see is that they just put less liquidity up in general, right? But then the other thing that you will see is that they will they'll maybe still hold their place in line, but they'll be more prone to cancel their orders when any volume hits it. That's the thing that I find really annoying. Is the pulling. Does anyone have any valid arguments against Elliott wave trading? You don't, because there is none. I see no scientific evidence suggesting that Elliott wave is a thing. Seems like maybe he might have something, but I've seen no empirical evidence to show that it actually is. Ooh, Lego will spend $1 billion on a new factory in Vietnam to meet growing demand in Asia. Can you believe that Lego is still like growing? Like, I mean, it was a big thing when I was a kid, and it is like so huge right now. I was at the mall the other day. It was like a huge line for people to get into the Lego store. I mean, part of that was like COVID restrictions, but it was like an insane line though. Like people really wanted in. It's like they're Legos, and people spend a lot for them. And then if it's a set that's like not available anymore, then people like if you have a set, like if you get a Star Wars set and they don't make that Star Wars set anymore, it appreciates in value better than gold. It's like, it's insane. 60 is even worse. Always 100 contracts at each price, but you can only observe real liquidity when it hits thick. 40 contracts traded before pulling thin. Everybody pulls, and it gets traded like 5. Oh yeah. But that's the thing that I think is so interesting about the market making, that you really learn from watching these micro treasuries, right? Is that the market maker doesn't know shit. The market maker, all he does is he provides liquidity, adjusts for the volume that's coming in, and on average, he makes, a tick per contract. And that's it. And they're mostly looking at a correlated instrument. In this particular case with the micro treasuries, they're just looking at the index that they use to determine the closing price or whatever, the settlement price. Right. And that's it. That's me. That's what they're doing. So if you can come in here and you can say, well, there's a 10-year auction today, and because there's a 10-year auction, this is what's going to happen. Do you have an advantage over them? Those robots? Yes, you do. And especially here in a situation like it is with the micro treasuries, because there ain't many people trading it, right? So you don't necessarily have to worry about going up against, ye old hedge fund or whatever. Then the answer to how you at home should trade becomes really clear. Either one, you can try and be one of the robots and somehow do something better than the robots, but you better have a lot of money to do that. Or you've got to know what's going to happen. You've got to be the informed trader. And if you're not, then it's really questionable that how you're going to be able to make money. Friend of mine trades Legos, buys massive bags from charity shops, and sorts them into rare sets and makes them. Really? That's interesting. TikTok has shown me a few things on Lego talk, and yeah, there's some people are pretty obsessive with it. It's just like not something that you would ever think like hardcore Legos, but apparently hardcore Legos is a thing. My favorite is this guy on TikTok. He will make he shows people illegal Lego builds, so he can get the pieces to fit together in some instances in ways that they were not meant to. And it's kind of funny. Every time I watch those videos, I'm like, oh, heresy! How dare he! You are a sick man. Oh my gosh. So there was a TikTok yesterday, man. This was one of my favorite TikToks in a while. There's this guy, and it had the words on the screen, when you find a Cat 5 network cable, because right, you should be using Cat 6 now. That's kind of the standard since everything's going to gigabit. And he says, for the crime of only transferring 100 megabits per second, I sentence you to death. And then he cuts the end of the cord off. And that was so funny. I'm like, that's what I'm going to do now when I come across the Category 5 network cable. I'm just going to cut them because nobody should be using them. Mm-hmm. Wow, the Jussie Smollett case defense has rested already? That was fast. I thought that would be a longer... I guess I you know what is something that if I had time I would maybe should do more research on is trials, and particularly dynamics surrounding juries and stuff, because it seems like I'm often caught off guard by what the juries will tend to do and how long things take and how that whole process works. So see, here they're coming up. I'm gonna bet you that they could even pull to like 1 spot 307 and they still won't fill me. They're gonna have to really go through me to get a fill. NASDAQ tweets, over the last few trading sessions, equities have clawed back most of the Omicron-inspired sell-off, and that looks to continue today. Thanks for the cheerleading, NASDAQ. I really don't feel like that you, as the exchange, should be doing that sort of a thing, but, you know, whatever. We still appreciate it. I have a giant bag of Legos. Should I cash out now or wait for the... I wonder how much you get paid. How do you price? How do you price something like that? Right? Like just a huge bag of, like, you could just do it on weight. Is it based on weight? You weigh the amount of Legos and there's an average going price for Legos. We could do then, if that's the way that it works, then we could do a Lego futures. We could make a Lego exchange. Oh my gosh, guys. We could do a Lego. This is a money idea. Make money, market making on the Lego exchange and the commissions. I mean, this is on estate sales. Legos are cheap. They sell them in bulk. Oh, really? Come on. No, they gotta be. I bet you that if it's like, you know, one of the, like a huge blanket of Legos, that's a couple $100. It's gotta be. Maybe not. Even then, you probably could still make money if it's the thing. If you rebuild sets, you can make Lego blockchains. Maybe what if we could somehow make Lego NFTs? I'm sure that could be a thing. $1 billion idea. Delete this video. Let's go do it. Yeah. No, nobody's gonna watch. We'll be fine. It can be our holiday project. Make our own exchange. You know what? That actually just making an exchange itself sounds like a fun project. Even if we don't know what you would trade on that exchange. Over here, it's about $10 per. There you go. That sounds reasonable to me. That sounds reasonable to me. We can create a Lego made of. I'm sure that it'll come. That I'm sure that Lego will do that for us. Yeah, that's the funny thing with NFTs is that people in the NFT space are so stupid that there doesn't have to be any actual attachment between the functionality of the um, of the cipher on the blockchain and the actual item that you're buying, right? So for instance, you can come in and you can say, here, I have this picture. It is an NFT and you're buying the rights to this picture. And yeah, anybody can go and take a picture of it and copy and paste and save it and do whatever they want with that image. And so the supposed ownership of that image does not give you any actual abilities beyond the abilities of anybody else on the internet, other than the ability to resell the NFT to somebody else and make money off of it. and people think that's value. Like the perception of ownership is something that they're willing to pay money for. It's and ergo you could feasibly, at least at the current time, you could feasibly mint an NFT of literally anything and make money from it. Now, metaverse, that's a different issue. So I saw a take on the metaverse that I thought was very good. And it was this, that we've had applications like Second Life in World of Warcraft for a very, very long time. Only hardcore gamers play that sort of a stuff. And why is that? Well, because the interface that you have is simply not sophisticated enough to engage the majority of people. Ergo, the like the real metaverse, like the real explosion in the metaverse, is probably still not going to come for like another 20 years. Like, because it's going to have to be to the point where the virtual reality interface works so well and is so intuitive that to people it's just like real life. Then maybe you could get some killer applications that make it worth it for people to want to spend a ton of time and effort in the metaverse. Banksy should make an NFT and delete that. Yeah, well, didn't he already? Or I think that there are Banksy NFTs actually, killer. Let's see. Banksy's Love in the Air set to be sold as 10,000 separate NFTs. There you go. Banksy NFTs sold through artist website for 244,000. Yeah, it's they're already doing it. Or was it? I wish I had saved the article. Remember we saw a headline the other day that was like, they did an analysis of NFTs and they found that it's literally like 100 rich guys just throwing money back and forth at each other. When you realize that that's what's really going on, it's really quite disgusting, isn't it? It's really quite disgusting. It's a bunch of rich guys throwing a bunch of money between themselves in the hopes that you're stupid enough to come in and put a bunch of money in too. So especially, what's the one most was read the 2-part comment? Oh, okay, hold on. I was going to start bad-mouthing Gary V, but that's okay. We don't need to do that. You talked earlier about volatility being the rock in our shoe because even when you're right about direction, it can still have adverse excursion. And the options might be able to help with it. I'm not sure, but maybe you can cap your risk by buying at the monies, but bear in mind, they price in adverse excursion for the time left until it expires. So ES options expiring today will cost like 20 points. Yeah. Well, but like, that's the thing though, is like, with buying calls, I can come in and I can say, if I get to the price that I want it beyond the price that I think it's going to get to, then I'm going to make money. And if it doesn't, then the amount of money that I'm going to lose is set. which is what we want, right? Like we want something where it's like I'm going to lose $500 if I'm wrong about oil, but if I'm right about oil, I'm going to make like $2,000. That's what I want. The problem is just that what are your chances of actually making the $2,000? With the way that they price them, they should be pricing them as too expensive at that point. And so the degree of movement that you're going to need to get in the money is, even if you buy them at the money, you're going to need to make, if they're $3 options, and it's going to need to go up $3, right? And they're only giving you $3 because the chances are that it's only going to go $3. So you kind of in this extra. So with the buying options, there's problems on that side too, basically, because you are buying something that is elevated already in anticipation that when it flips back down, they're underestimating the amount of volatility that they're going to have on the other side as it reverses as well, which is kind of the bet that we're making in oil. And so far it's been working out, but we'll see. Today they slowed down a little bit. Oil is still just kind of ranging around 72 right now. Yes, I'm taking things for my ADHD. But I'm totally down with, just going where you guys take me. In the moment, guys. We're in the moment. You pay up front, so the movement should be higher than how much volatility is already priced in. Yeah, exactly. Otherwise, it'll go your way, but you'll get the crush, right? I forget what kind of crush they call it, but yeah, it's hard. But at the same time, it makes it really clear why options trade the way that they do and why they get so popular and so forth, right? So probably the best thing to do is to sell the options, to sell puts or whatever. But you've got to have a big bankroll to do that. I don't think that we should compare different stimulant-based medications against each other on stream like that. I could say that they affect different chemicals to different degrees, and so it depends on the person. TLA says there's no advantages to trading the options other than it is a swing. Yes, there is. Because so here are the advantages to options. Okay, number one, you can more precisely define your risk. So you can say, I think it's going to go up to here. I think it's going to take this amount of time. I think that this is what the volatility of the market is going to be, et cetera, et cetera, et cetera. And so based on the different scenarios that you see out there, you can craft your strategy to best account for what you think that the risks are. Whereas an outright swing trade, all you can do is say long or short. So that's the first thing. And the second thing is that you can limit the risk. So of course your risk is limited to the price of the option. So like if you're buying an option and it's $5 option, then that's $500. But then that's the most you can lose. Whereas if I go long oil and it continues to go down, for all intents and purposes in futures and the size of our accounts, there is no limit to how much you can lose, right? What about OTMs? If you want to buy ES but lower, say 45.60, buy OTM puts 46.50 strike and leave a limit buy order on the underlying, it will be way cheaper and you're fully protected from adverse excursion. Yeah. And then the other side is, when you actually own enough of the underlying to hedge yourself with the option, then things get really, really interesting. And very good reasons why those exist. So I'm not 100% sure if it's the complete solution for us, but it's something that we need to look into. But I think it's more than just that. I also think it's like, can we look at the treasuries, for instance, and the kinds, like, we know that there are different strategies. For instance, there are CTA strategies out there, right? Like, we understand how CTA strategies work and how they follow momentum, right? And we can use that to some extent to predict future order flow in the treasuries based on CTAs, right? Can we go in and investigate how CTA strategies behave during periods of high volatility to better predict the order flow during that chaos, so that we can select more optimal trades? Because I suppose the issue with the volatility is, like it was with oil, we know that eventually oil is going to turn up, but at what point do you actually buy it? That's hard. That's hard to catch, and you're not going to catch it just randomly. But if we know something about the CTA strategies and everything else and the way that they're going to react to volatility, we should be able to, pick an optimal point. Yeah, let's reset everything here. Treasuries look like they're going to attack the upside here now. S&P 500, they're just kind of retracing that big gap when they gapped up to 47.10. So it wouldn't be too big of a deal. And then even here in the treasuries, there's a good possibility that they pull back again. So we just kind of wait here and see what they do on the open. We still got a good 20 minutes or so before that gets going. But anyways, it's basically like, are there things that we can use during periods of high volatility to make effective short-term predictions? Because with the way that works right now, the things that we have that we can make effective predictions with don't work very well when there's high volatility. So we need to find better predictive edges in high volatility, I think. How can you claim Elliott waves don't work? You can't. It's a predictive tool. I can say that the null hypothesis should be that it doesn't work, and the null hypothesis has not been disproven. When one should assume that a trading strategy does not work until it is proven that it does. That said, I find it really weird that retail traders in general seem to dislike Elliott wave more than other things, and I don't know why that is. Is there some sort of analysis or book or something that some influencer says that is very anti Elliott wave that I'm not aware of? Because it just seems weird that find proof. Well, there's many different ways that you can try and prove something, or that you can provide evidence that it might work. One thing might be like a back, a 4-year programmatic back test showing that it works. Would probably be the best thing. It's an algorithm that trades based off of value wave and showing that over a multi-year period that it's effective. Uh-oh, Gus, I'm gonna have to admonish you for asking dumb questions. Gus knows. Gus is one of our best students, I feel. Like, he puts in the work, and he's there on Discord, and he asks questions. He's serious. Good on you, man. Volatility isn't that regardless of the direction. Yes, that's true. Generally, when we think about volatility, well, so really, I think that there's two definitions of volatility that we can use, and they're kind of related, but they're kind of different too. Like one volatility is just the VIX index, which is a calculation that is made based on what options are pricing in, and it's a big complicated calculation that I don't understand. Okay, but more broadly, volatility is just thought of as how much an instrument moves within a specified time period. So particularly when we're doing like models, looking at market microstructure, and they talk about volatility, what they basically mean is what is the true range of the time period that you were measuring. And yeah, it's regardless of the direction, essentially. But the split side of that is that volatility is always higher when the S&P 500 is selling. Yeah. Some strats cannot be backtested. Like, how do you backtest a discretionary strategy? How are there some pretty good discretionary traders? I think. Well, okay, so this is where it gets kind of funny, I think. Well, hold on. New Squawk talking. So if you are trading something that is based on technicals, and you cannot write an algorithm about how to do it, then how can one say that it is an effective strategy? Or more broadly, like if the argument is informational edge versus statistical edge, which is what my argument comes down to, that you're probably better off using informational edges as the primary basis of your trading. So and a lot of people want to argue against that, and they say no, just watch technicals and do technical analysis and trade what you see on the chart. Okay, well, it's one thing that you're not sophisticated enough to write that algorithm, but if you're not sophisticated enough to write that algorithm, how can you know that the profits that you might have derived from your trading, assuming that you were profitable, actually that edge actually came from the technical analysis that you're doing, and not something else like the informational edges that you might have and not consciously realize that you're trading off of, right? To prove that there is truly a technical edge in something, I really think that you have to be able to define it algorithmically and show it on a backtest. Otherwise, there's no way to, split out the technical thing that you're talking about from everything else that affects what trades you take. Gus says, so yesterday, for example, was a volatile day. Yeah, I guess you could say that in a way, that we traded a pretty wide range in the S&P 500. But that there are some pretty good discretionary traders just makes me think, well, yeah, because there's a lot of informational inefficiency out there. And these guys are probably like, that's one of the things is that there are some people out there that have claimed to make, like Mark Minervini. He seems to have made some money from doing this. He did like win that trading contest, right? They had him on CNBC and he's like, oh, we really like this stock. And then they asked him, oh, okay, but do you know this and that about it? And he didn't, and he kind of like bailed on him, right? So how do we know if we say, okay, yeah, he made money? Why did he make money? Was it because of a technical analysis that he knows? We can't prove that. We can't prove that. Let's say someone purely uses TA. So if someone purely uses TA, then they should be able to talk to a talented program and be able to define it algorithmically. If it really truly is purely TA. You might need somebody that's really gifted and understands algorithms more effectively than I do. I'm hoping that with this statistics, I can already see, even in the first chapter going through some of these statistics, I can already see how it sorts out, where it's like, okay, you have these two conditions. Like the example that they gave was, you have a football player and X% of the time he plays well and Y% of the time he doesn't play well. And when he does play well, he usually throws one interception. But when he doesn't play well, he throws more than one interception. So if he has already thrown an interception, then what is the probability that he's not playing well that day? And you can use Bayes' theorem to sort this all out. And I was like, oh. So now we can do that on the S&P 500. We can say, okay, X% of the time the S&P 500 moves up. X% of the time the S&P 500 is up in the overnight session. So if we are up on the overnight session, what is the probability that we're going to have a bullish day? And then we can use Bayes' theorem to sort that out. And then I think what you do next after that is that you can do what do you call it? A graph where you have it like a decision matrix where you can say, okay, X thing happened. What's the probabilities? Go to the next step. Now on step 2, Y thing happened. What are the probabilities? And it updates based on how things progress. Orders don't move more. If only that were true, air cages. This is the thing that's so funny, is like, if technical analysis worked, trading would be so much easier. It would be so much easier. Well, TLA says that depends on context. There are different setups depending on who is stuck. Okay, so first of all, depending on who is stuck implies a informational edge is being brought into the equation, right? But two, that's still kind of like a programmatic thing. That's still like, okay, in situation X, you want to use this you want to look for this pattern, and in situation Y, you want to look for this pattern. That's totally fine. That's a little bit more complicated than what I tend to do, but what you do to make a strategy like that, I don't necessarily like filter them multiple. What I'll do is I'll just have a strategy. I'll be like, okay, here is a head and shoulders pattern, and you want to look for head and shoulders under these patterns. And here's a moving average crossover strategy. You want to use that under those conditions. And that kind of sorts it out. Is you just split each of those setups into their own strategies, and you put qualifiers on them as to when you are more or less likely to want to use it. right? But that is still like heavily back tested and doesn't work as far as I can tell. At least certainly not the kinds of strategies that retail traders tend to look for. But there is one thing. Here's one thing that I can give you on technical analysis. And this is actually the true basis of most technical analysis, believe it or not. See, let me see if you can follow me here. The stock market tends to move up. That's really what it comes down to. And so most technical analysis strategies that you see out there, like you'll see some guy, they'll say, hey, I have this strategy, it seems to be making money. And what you're going to do is you're going to go and look at it and you do like a deeper analysis and you're going to find, okay, so where is this technical analysis strategy deriving its edge from? Why does it seem to work? Oh, because it likes to go long and the S&P 500 tends to move up. And that is like particularly with a simple moving average crossover. Simple moving average crossover, if you don't implement any stops, does outperform the index on an outright basis, but only because the S&P 500 tends to move up. And if it doesn't move up during the time period that you look at, then you will lose money. So many big words implies the informational edge being brought in. How else am I supposed to say it? You know stuff about the market and you're factoring that into your trading without realizing it. I really think that's what a lot of these guys do. You can use volume profile just like you use the tapering. Well, from what I understand, there are some things that we will see in the volume profile, particularly with the way that the volume profile shape comes out, that there tends to be a distribution. Because if it was all random, then you would expect to see the volume to be all random too, but it doesn't. It distributes around certain locations. Okay. There's reasons that happens. Now, why does that happen? There's multiple theories, and most of the theories that I see reported out there in regards to technical analysis don't really make sense. Particularly this idea that everybody agrees that price is good is dumb. to be frank with you, because if everybody agrees that the price is fine, then there's no reason to trade it. But we know from more serious scholarly research that the reason that those nodes show up is because liquidity holes develop. And because of the liquidity holes develop and constrain price, but people still disagree with the price, you can get a lot of trade going back and forth in that location in the long run. And so then it ends up, there'd be a little liquidity hole because nobody wanted to trade that, or that everybody that wanted to trade that already traded it. And then they're stuck there. And then because they're stuck there for 45 minutes, the amount of volume that does end up trading there in that 45 minutes traded in such a narrow range ends up creating the point of control. And so people trade around that, right? That's why it happens. So could you potentially, can there be statistical aberrations in the volume profile? Yes. Just like there are statistical aberrations in almost everything else. So like again, the S&P 500 tends to move up. But more broadly, markets have a tendency to trend. Okay. And so technical analysis is really trying to take advantage of the trend, right? So what does that mean? It means that technical analysis isn't necessarily entirely useless. It's just that, one, you have to prove that the thing that you're talking about is really actually a thing, and that, two, you're going to need to combine it with your informational edges. You combine it with your informational edges, and then hopefully, you can sort out better entries. happens because of the nature of markets set prices in information, but not effectively. So value is never an exact price. It's a range where most trades will happen near the center. Well, yeah, but let me put it this way. Okay. The further away from true value the current price is, the more people that should want to trade it. No. And if we're close to that fair value price, then you would expect that not very many people would want to trade it. We're seeing some strong buying going into the open here. We'll see what happens on the open. In the ES, you see all these, I'll pull it over here. There's like a bunch of buy-side icebergs and stuff. They bought it up like 3,000 contracts going into the open. But I guess to be more buzzwordy about it, so that you guys know what to like research, I think that the studies that they've done on the statistical properties of Walrusian auctions disproves the generally accepted principles of auction theory. Yeah. Wanting is a thing, but you may know well from working in Goldman that the most market participants don't trade because they want to, or rather because they have to. Well, yeah, but I would still say that more broadly speaking, that if we're close to value, there should be less people that want to trade, and ergo that price that is value should not have a lot of volume at it. But that's just the thing, is when you really watch how they form, just watch it next time. In the Treasury in particular, okay? You'll be going along and you'll see there'd be a price where they just skip over it. It's like, they're only willing to put 100, they're only willing to put 264 up there, right? And then they'll come down to the 06 half, and 06 half pulls, and so maybe they trade down to that. But then 06 half doesn't leave an offer, and they trade back up, and then the 07 pulls too. And so neither bids nor offers are willing to put up more than like 500 contracts at any of these prices in the middle. What do you get? You got an area of low resting liquidity that constrains price in that location. So even if people want to trade it, even if people think that price is bad, it will require more volume than usual and a larger imbalance of volume than usual in order to push out of that location because of the situation in the liquidity. And that is why point of controls happen. And if you watch it, you will see it is extremely consistent. And you would think, well, I think that retail traders ignore it because, well, that just means that you don't want to take a trade right now, right? Yes. But if you know why it happens, then you also get to know what has to happen in order to get out, right? We either have to have a really strong imbalance in market orders to push us out of the range, or that liquidity hole has to heal, which takes a pretty consistent amount of time in most instruments, 45 minutes in the Treasuries. Then okay, we just formed a liquidity hole, so I don't want to take a trade for another 45 minutes. See how that works? But there's a study about Walrusian or Walrasian. Why do I want to call it wool? It's a Walrasian. WALRASIAN. There is a study about it. And that study seems to explain why those distributions happen, and it seems to explain why we get a square root law of meta order impact and a bunch of other things. And it's a fairly recent study. I think it was like 2008 or something. Now, maybe it was even more recent than that, 2012. Go find it. I'm telling you. But is that, from the strict definition of technical, which is, we say, based on information only generated by the market, from that perspective, you could call it technical analysis, right? So you say they don't, well, but it's not fair. That's the thing, is it's not fair value. It's not fair value. The location does not form because it's fair value. The location forms because of the liquidity hole. And that's why I say it's important, because all of this auction theory stuff is based on this idea that that price there was important because it was fair value, which is a false assumption. It's not fair value. It was formed. It was more likely. It is more likely that that location was either the closing price or a liquidity hole. I think the polling is just they're trying to get better prices. No, well, no, it's that the market maker doesn't really want to take fills in that location. The market maker is going in there and they're saying, well, why should I take on a bunch of buys in here? You know, like if this goes through and I take every buy that they're going to give me, and then it goes out of this location, I have no way to know that it's going to go up or down from here. I don't want to take fills. Right? But here, I was doing this on my TikTok the other day. But you've got to look at it like this if you don't understand why they occur. If I can pull my pen up here, I know I have it on. Where are you? Hold on a second. Oh, there it is. Okay. You're going to have, if you're doing a Walrasian auction, okay, then the way that a Walrasian auction works is there's like every 5 minutes, there's an auction. So you all put in your limit orders, and then at the end of 5 minutes, those orders are matched up against each other, right? So you're going to have something like, based on what the current price is, you know, certain number of people, they're going to want to, you know, buy it, right? And maybe they don't want to buy it like right at the current price, but you know, once you get a far enough away, there's less people trying to bid. Why? Because they won't get filled. They're less likely to get filled, right? Okay. And then on the other side, there's going to be people that want to sell it, right? Something like that. Okay. There's going to be a lot relatively close to it and not so many far away. Okay. So what happens? This area in the middle here is people that get matched. So the people in the middle get matched. The people beyond that didn't get filled. Okay. So these people from here, let me use a different color for that. These people from here out, those orders are still going to be there. Okay. These orders aren't going to be there next auction. Now, some orders will add in again, right? For the next auction. Okay. But because so many people got filled in here, what's going to be the picture next time around, right? It's going to be like this. Because these guys in the middle already got filled, right? So when you look at the liquidity is like this, right? At the current price, there's not very many limit orders. There's not very much liquidity that wants to trade it. If you go down too far, then you run into a bunch of buyers. And if you go up too high, then you run into a bunch of sellers. And so in order to get out of that location, you're going to have to get more. You're going to have to get more buyers, you know, than what this thing is. It's going to require a larger impulse. Yeah, there are no market orders in a Walrasian auction, though, right? It's just everybody puts their limit. This is how the Taiwan Stock Exchange works, by the way. You just all put your limit orders in, and then, if you're matched, then you become a market order. Okay. But yeah, it's going to require an impulse of market orders to push them out of there. That, or there's going to need to be enough time where that hole fills so that, it's more even, right? That's what creates the hole. And then because they're stuck in the hole, everybody that wants to buy or sell has to do it inside of there. And so price ranges back and forth. And if price ranges back and forth in that location for 45 minutes, even if nobody agrees on the price, you end up getting a lot of volume there. Right? So again, the assumption of, let me pull up my thing here. The primary assumption of auction theory that point of controls represent areas of price agreement is just objectively false. That's not why they happen. Most of the time. I mean, I suppose it could happen that a lot of people did agree on the price and they kind of settled at that price that can happen, right? But just because there's a point of control or there's a volume node in that area doesn't mean that people agreed on that price. Yeah, it's just what I was saying before is just kind of like the easy way out of explaining that, right? Well, why are they trading it if they agree? You don't take a trade if you agree with the price. But don't believe me, go read the study. And then, how do you use that? Like I said, timing. Takes amount of time for the hole to heal. And you'll see it here in the Treasury, right? You get a move. We had a pretty strong move down. It ended at 6:30. So now we're going to have to wait. I guess because today it's going to be a little bit different because we do have a piece of news at the top of the hour, right? So what might happen in the Treasuries is they might sit here and wait for the jolts, and then they'll do something. I wouldn't be surprised, by the way, if the jolts is bad. I don't think that it's really going to make a huge impact, short term, at least not in interest rates. But I'm starting to see some pressure in the job market that might suggest that the pendulum is about to swing the other way, and that companies will be putting out less job listings and trying to be more efficient. But we'll see. I wish I had. I can't exactly remember the exact name of it, but that's what I'm saying. If you go to SSRN and you search for Walrasian, then you'll probably find it. You might find more than one on the subject. That was like a big long thing, and then we didn't have another subject to go to after that, and I'm still kind of watching this range back and forth in the Treasury, they are still steepening a little bit. I do think we could have another leg lower, maybe, but if we do, it may be in the 30-year end of it, right? Walrasian, WALRASIAN. They talk about it in Jean-Philippe Beauchaud's book. It's like the last thing that they talk about before they start going into kind of the more implications and so forth. When I go back and read that book again, I mean, I didn't like go and read the book again the whole way through, but like I'll go and like review certain subjects and stuff in it. I realize how brilliantly they laid it out. Like they really did go through and were like, okay, I'm going to teach you everything you need to know about market microstructure. Okay, now that you know everything that you need to know about market microstructure, what do we learn from it about why markets are the way that they are? And then all of a sudden, it's like abundantly clear that, oh, markets are actually relatively statistically efficient and informationally inefficient. And that's why we get some of these weird behaviors like autocorrelation and trends and volatility and so on and so forth. Right? Like market microstructure basically has an answer to all of these questions that people have been arguing about for hundreds of years. I mean, there's other theories out there, like there is the technical analysis theory of things, but there's a lot of holes in that argument. So everybody's always said, well, there's this problem, there's this problem. But when you look at the market microstructure argument of it, it's like, but we have like really effective empirical evidence about all of these things, and it solves all of the conundrums. And there hasn't any of the conundrums that we've brought up in the market microstructure world, we just kept doing studies and we found answers to in the market microstructure. And yeah, I think it has big implications too, because there are so many things that we do in finance and in the world that are based on theories about how markets work that market microstructure suggests are wrong. For instance, technical analysts believe that the markets are efficient, that the chart contains a record of all available information in that market. Well, market microstructure kind of destroys that picture. So if markets aren't efficient, then why should we do something like, let's make a currency where the whole thing is based on what the market thinks? Then we should have a more efficient economy, right? No, wrong. And what have we seen? Bitcoin is extremely inefficient, right? Because Bitcoin at its heart is a radical acceptance of the efficient market hypothesis. But if the efficient market hypothesis is wrong, then the whole experiment is, poorly designed. It's bad from the start, right? Another thing is like how we mark to market is one that's like a really big deal. Regulators are basically leaving an inefficiency in markets that allow options traders to have a large impact on price. What's the word that I want to say? That they have more impact than they should because of how options work, because they don't have to factor in the impact of them selling on their mark-to-market profits, which gives them more margin to play with than they should actually have, which not only leads to larger moves than necessary, but also leads to higher volatility than necessary when things fall apart. Because when those people do have to actually sell, the mark-to-market models do not properly account for how much you're actually going to lose when you try and dump that position. And there's many other, I think, things that we can take from that, but kind of when I realized all those things, that's when I started to say, oh, I should be teaching people this stuff more. Because killing the efficient market hypothesis will benefit the world. So we can say, oh, our markets are not all that efficient. What can we do potentially? How can we change the structure of our markets to potentially make them more efficient? Then we start to get into real interesting things, right? Well, we're still in a holding pattern for the JOLTS numbers. So I don't think the Treasuries, although the 30-year is awfully down there, the Treasuries at the moment don't necessarily look particularly interested in moving, other than the 30-year just chilling at 161.16 and on the verge of being able to drop any second. The markets are inefficient due to one factor, risk, and H. No, it may be the case that also leads to market inefficiency, but what I would say is I think that a more what is, man, I'm having trouble with finding the big words. I always want to use the big word. A more concise explanation of why markets are inefficient is that the structure of markets leads to a very inelastic market. And so the demands on liquidity lead to excessive price movement, essentially. That's also due to human behavior. I don't think that we really have good evidence for that, to be honest. So this is something that I think is really funny. Is like, so, hold on. The News Squawk is talking. So basically, markets don't know shit. Nothing is priced in. Yeah, well, it could potentially be priced in. So again, the reason why something might not be priced in is because demands on liquidity outweigh everything else, right? So if I am a hedge fund and I need to rebalance my portfolio, the effect that I have on rebalancing my portfolio on the markets is significant and long-lasting because of the way that the markets work. But it's the liquidity is going to respond to my orders, and then once we get there, it's going to remember that price. There's the memory effects of it because the way that liquidity works, and the degree of movement that you get just from a fund rebalancing their portfolio ends up being larger than the difference between, that move is larger than the move that, like, what would be fair value, right? And so the liquidity basically ends up moving us to outside of value a lot. Okay. So does human behavior lead to market inefficiency? Well, one would think that yes, one would think that almost certainly it must. But the problem is that because the effects of inelastic markets lead to so much market inefficiency, whatever kind of inefficiency that you may be able to derive from human behavior is simply imperceptible from just noise. Because again, like, the noise out there that you get from the demands on liquidity are so big. So we haven't been able to go and look at the way that a market behaves and pull out real human behavior tendencies from it. Technical analysis claims to be able to do that, but then we go and we look at technical analysis and it doesn't work. All of the studies that we do, they show that, like, when you do find one, that you're either not looking at the full picture of it, and including fat tails and so forth, or you're curve fitting. You're testing like 10,000 of them, and then you're picking the one that works, and then that doesn't necessarily mean that it continues to work. Okay. So the technical analysis was unable to prove those human inefficiencies. So they had to invent a new field. which was what do they call it? Like market psychology, whatever. And this is like a fairly recent field. And the way that they did this was, instead of trying to watch the market and see how the market responded to it, they had to look at the people themselves and how the people tend to behave in certain situations. And then we started to learn things like, oh, okay, people are wired to care more about losses than they are profits, for instance, right? Those are the sorts of things. So like you should theoretically be able to turn around and use that to make money, right? But again, the effects of the inefficiency created by human behavior is smaller than the effects created by simply the market moving around liquidity from completely uninformed random stuff that has absolutely nothing to do with what the fundamentals or investor psychology or any of that stuff is just a random point because a hedge fund was rebalancing, right? So all of those things are probably good to know. And just like I said, like technical analysis is good to know, but what should be the primary basis of your trading based on what we know probably should be trying to take advantage of informational inefficiencies, because that is the largest inefficiency that we know of. And that doesn't even necessarily mean fundamentals. What it means is anything that you can find to predict future order flows. So understanding how a CTA strategy works would be a really effective informational edge, right? Or maybe let's because I don't know how effective necessarily. Let's say it could be a potentially useful informational edge, right? Now on the point that Gary said about one factor risk. Well, maybe I don't understand what he means by that. If I go and do a search on that, does that mean something more than I think it does? This is related to the capital asset pricing, I think. We find that volatility is another consequence of market microstructure, that the market moves because of orders. The more orders that there are, the more that it moves. And when it moves that much, that then prompts other orders to come in, and it creates more orders and from what I can tell, at least, more random orders as well. And that's kind of what leads to excessive volatility. So again, market microstructure has an answer for what causes volatility. And they very well correlate. Like they can go through and they look at these models and they say, okay, this model shows that you can get price movements of X. And then when you look at the actual real market behavior, it matches up what the models say. So volatility is just another consequence of the market inefficiency caused by inelastic markets. But here again is just like with the it's just like with auction theory. Like with auction theory, some of their premises or some of their theories are wrong, but some of the consequences from those theories end up being right anyways. And it's the same thing with a lot of risk theory out there that doesn't factor in how market microstructure leads to that volatility, right? So all of that information about volatility is still useful. They still don't want to fill me. So the Treasuries have come back down to the low end of this range. The 30-year broke new lows. The 5-year has been trying to keep up. They're not. It's steepening a little bit, but the 5-year is trying its best to not go. Okay, what is an information inefficiency? So an information inefficiency would be that you know something that predicts future orders that is not properly priced in by the market. When price moves get inelastic, well, I just realize like all markets are always inelastic. We're not quite sure how that elasticity might change based on factors. So we don't know that yet. So we shouldn't talk about this market is more or less inelastic, because that's your guess is as good as mine, sort of a thing, right? Yes, behavioral finance, that's what I mean. Well, you could have a behavioral finance. Okay, so here we're getting so you see they pulled one spot 306 and they didn't hit me. We're doing Econ 1 now, yeah. So you could have a behavioral finance theory of volatility, and you could have a market microstructure theory of volatility, and they could both have evidence in favor of them. But I would argue that the evidence in favor of market microstructure explanation for the cause of volatility is a lot stronger, and doesn't necessarily conflict with the behavioral finance explanation. Rather they can both be true, but the market microstructure explanation of it is going to be more useful to you in trading. Okay, well, but that's where it gets interesting, right? If the model explains the microstructure, how does one exploit the reaction and response of price discovery? Well, New Squawk is still talking. Because it's the Bank of Canada interest rate decision. Okay, anyways. Okay, so how does one exploit the reaction in response to price discovery? Well, okay, so when we get into market microstructure, okay, there's 4, or is there 5? Maybe there's 5 empirical properties of markets that are a result of market microstructure that you could potentially take advantage of. They are causes volatility, causes autocorrelation or trends. It causes the square root law of meta order impact, which is that when you the size of an order, the larger it gets, there's a point where the impact that it has starts to trail off, and that's why a big move can kind of only go so far. The inverse sine law, which is that when you have a large meta order, then followed by another large meta order in opposition going the other direction, because of the wake caused by the first meta order, the second meta order will have a larger impact on price, leading to, here again, volatility, more volatility, right? So the inverse sine law, and then on the other side of that there are liquidity holes, right? These areas of low liquidity that can constrain price. These are all kind of the same. All last 3 of those, the square root law, the inverse sine law, and liquidity holes, all really have to do with liquidity holes being out there. And then that there is a certain timing, there's a certain amount of time that it will take for the liquidity to recover based on the current number of limit orders that are being added per minute and removed per minute. And what the liquidity actually looks like in that location, and so on and so forth, right? Those are empirical properties that you can pick out that you could potentially use in your trading. But then the other kind of consequence is that because orders have impact and they behave in this way, the market ends up being very statistically efficient too. So it's really hard, if not impossible, to come in and look at any kind of statistical aberration that you see in price and really make money off of it. Because once you start trading it, it's going to close that gap. It's going to remove the inefficiency from the market, and the number of orders that it's going to take to close that gap is going to be a lot less than you actually think. It's a lot easier for those inefficiencies to be arbitraged out of the market than you might realize, right? So again, that's why I say like the biggest takeaway that you get from all of that is that the two biggest takeaways that you can get from that is that, number one, the most important thing that you can do is find predictors of future order flow, because it's the order flow that moves things. And if you can predict what these large funds are going to do based on how their systematic strategy works or whatever, you can take advantage of that. And that those inefficiencies, people think that should be priced into the market, but that it's not, number one. And number two, if you are going to be looking at any kind of statistical inefficiency, you need to be looking at the order flow itself and not necessarily price, because price doesn't tell you anything. Price is just the result of what was happening with the orders, the interaction between market orders and liquidity. Yeah. And I mean, that's really more for what we do as scalpers, right? Because really all of this market microstructure, the way that this all started was people wanting to discover models to improve their market making algorithms, right? Okay. I love how it's like, okay, here I just introduced you to the wonderful world of market microstructure and the groundbreaking, game-changing things that we learn from it. And here you're talking about, okay, if you have a 30% chance it goes up and a 30% chance that it goes down and a 30% chance that it just doesn't go anywhere. Okay. I mean, that's the thing. So we talked about those different empirical properties. So probably the most well understood and exploited empirical behavior of markets that we learn from market microstructure is that implied volatility is going to tend to be higher than realized volatility. And ergo, if you're going to do market making with options by selling options, tends to be profitable. Granted, of course, that you are able to deal with the tail risk. And there you have something that based on a market microstructure, and you can use that in your market making for options. And they do. Right? For us, it's kind of those liquidity holes, I think, end up being really important, because we kind of know, like, if I've got a short on and I'm just, only looking for a one move, and I see a liquidity hole show up, there might be another impulse move us down below it, but then we're likely to get sucked back up into the liquidity hole. So once I get that impulse beyond the liquidity hole, it's probably best to take profits if you don't want to be in for longer, you don't think that there's more in the move. Or if you're not in a trade and you see a liquidity hole, you should be able to sort out when the market might move again based on future events that are going to happen, like timed news releases, right? And they finally took me. Okay, and how long it's going to take the liquidity to recover. So I can come in and I can say, oh, okay, we had this move down. It kind of was didn't do this one very well in the 5-year because look, we had this thing come down. There was a liquidity hole there at 23.5. And then what happened? We got stuck in the liquidity hole. In that instance, I was willing to let it go for a long time. I actually wouldn't be opposed to letting this in the 5-year run. But number one, the 30-year is moving more, so I'd rather be in the 30-year. And number two, like, nobody traded it. Like, I was the only person in the 5-year, so I kind of felt like maybe this is dumb. I mean, it is dumb. It is dumb, but to me, it was like, okay, let's let them off the hook. I made $10. Now let's get it back, and everybody will be flat again. And then there's going to be some poor guy over there that, is the market the guy that programs the market maker for the 5-year treasury. And they're like, man, why did we lose $10 today? And then somebody's going to go there. Oh yeah. I watched Seth's stream and he took a trade because he knew what was going to happen. Because why? Because knowing what's going to happen is the strongest edge you can have. Informational edge, the strongest edge you can have. Like, that, it's actually kind of mind-boggling to think about. Like, we think, okay, we used an informational edge and we got just destroyed in oil, even though we were right and we had everything, Okay, so if you have a really strong edge, and that's the sort of stuff that can happen, then think about all of the roadblocks in the way of you making money just from technical analysis of price, right? When you really go and you look at all of that, it becomes really clear, in my mind at least, that trying to trade purely off of technical analysis is kind of stupid. No offense to anybody that does that, but based on the empirical evidence that we have, it seems to me that trying to be profitable utilizing only technical analysis on intraday timeframes and futures is probably not very wise. Account for the variable change when price discovery is illiquid at different prices due to risk at hand in the current environment. Yeah. Well, and now this is what I think is so fun. This is another thing that's fun about volatility is that it is inevitable that there will come a period where there is more volatility in the market than what the market had priced in because of markets being inelastic, right? Of course, once it goes up, then you can sell the options and stuff. But in the short term, it's like, everybody says the way to make money in options is to sell options. Well, that's the easy way to make money in options, but you should be able to, using informational edges, come in, be able to predict that volatility is going to be higher than what the market is pricing in and take a trade. And you just might not want to hold those all the way to expiration. Seasonality is a great tool. It is, because seasonality has from everything that I've seen shown itself to be a fairly effective predictor of future order flows, a consistent one. I mean, obviously, are you going to make money just from seasonality? Probably not, but it seems to be an effective tool, yeah. Just for reference here, I don't like when I get into this, like, the teacher mode like I am right now, because I could come in and like make a really bad mistake, right? Like this trade, maybe I'm feeling like this because I have a good trade that I've been in for a few days and is going well. This could like completely reverse on me and end up being like a really terrible trade in the end. I don't, it's possible. I probably should be trying to push this more. Like I had 2 contracts on. I just took one off. If this comes back, I might put it back on, or maybe even do 3. Maybe I should be more aggressive. I'm not perfect, right? Only talking to you guys about this because it excites me, and I feel that it really has world changing consequences. What I'm teaching you, and I want more people to go in and look at it. I mean, it's not a simple subject, right? You were talking about years and years of scholarly study, okay, for them to figure this stuff out, right? And that's the thing, is I didn't come up with this stuff. There is no way in a million years that I would have figured all that stuff out on my own, okay? I don't say this stuff because I've been trading for a long time and through my experience I figured it out that this is the way that markets are. I don't think that anybody would ever do that. But like, the conclusions are in many ways counterintuitive, and there are very much counter to what we want to believe about the way that markets work. And so I think it's really important that I stress the fact that this is based on the work of researchers at the top universities in the world, working for over 30 years to try and understand why markets behave the way that they do, and what actually is the behavior of markets. TLA says it's not easy to make money selling options. It's only on Twitter. Wow. Okay, just because we know that there's an inefficiency and you can make money there doing it doesn't necessarily mean that it's easy or hard, right? Clearly, though, it is a source of significant revenue for options market makers that have the resources to really do it properly. AKA Citadel. You do not sell options 5 to 10% out of the money. How, do I even have, I don't even have it. I should come and take a look. Oil, I want to know where, so hold on a second. Because I kind of bought an out of the money option, right? But I don't, at the time, I didn't think that it was really that far out of the money, but maybe it actually was. Man, so when we come to the volume profile for the 10-year, you kind of start to see that this is like turning into a bloodbath. That we're not even necessarily like in a huge range for what the volatility has been recently in treasuries, but like there's 130 still below us that we could potentially move to. Yeah, there's the oil report. What was interesting was the way that the draws and stuff have been going. Okay, so when I did it, I was getting... oh no, that's the wrong one. Yeah. Oh, why does it change it? I don't want that. I still want to keep an eye on. I hate how it keeps changing my... Let's see if I can fix that candlestick, and then maybe if I come in here to settings or layouts, save, maybe that'll fix it. Okay, so yesterday they got to a high of 52.5 in USO, and today they're 52. But at the time I bought it at, now I can remember, 49. So that is like close to a 10% move, right? Yeah, 11% move was what I was expecting. So it was fairly out of the what is that line? It is just a line. Where do you go? Oh, it's where did I set it? It's set right here. So way back in October, we bounced off of that line, and that ended up being like the low of the year. And since then, they keep crossing back over it, and you'll see weird stuff happen at that price. So it seems to me that somebody has a long-term position on that they manage based on that price. So I just kind of watch it, but I wouldn't think about it too much. Just because I have the line up there and I think about it doesn't necessarily mean that I take a trade based off of it. It's kind of more of like just a good reference, you know? It's like, oh, okay, this was a key point at one time. Are we above or below that now? Because if I'm doing an informational inefficiency, right? Look at my chart again. I should probably make something that draws a little arrow where the news point occurred, but you know, I want to know, okay, this move down was because of Powell, this move up was because of non-farms. What was the cause of all of these moves? Is there a move that is not in line with what the fundamentals are? That's like where I think you get the best trades, is when you get a move that happens because of short-term liquidity concerns and it contradicts something that we know is going to happen. Like next week, we know that obviously we don't know 100%, but we can be pretty confident that next week the Federal Reserve is going to increase the pace of tapering. Based on everything that they've said and everything that we know, we can be pretty confident. So anybody that's buying up the treasuries right now, they're kind of off sides, right? So why are they doing it? They're doing it because of short-term liquidity concerns. In this case, I think largely fears about Omicron, which we know isn't really a big deal, right? So that's why I do that. But that doesn't mean that like I completely ignore what those prices are. It's just I'm gonna want to try and use that to try and track the meta orders, right? So I say, okay, Powell was a big sell meta order. Non-farms was a big buy meta order, which made absolutely no sense to me. But that's what they did, was non-farms they bought up. That was a big buy meta order. And I think that there's still a larger meta order about interest rates are going to rise because they're increasing the base of taper and they're going to raise interest rates 2 times. That is going to create a future meta order that will be a sell that I can take advantage of. Hence, I'm short and holding it. They're not going to raise rates. We'll see. I find it awfully curious how insistent every time that I say, it's not just, I know Air Cages is kind of trolls me a little bit, but you know, if I go on TikTok, anytime that you sit down and you say they're going to raise interest rates, there's somebody out there that says they can't raise interest rates. They're not going to do it. Watch them. Visa has launched a Bitcoin consulting service to help further mainstream adoption. Okay. So this is interesting. What's hitting all-time highs today? Apple, Dr. Horton, I don't know what that is. Lennar, Lowe's, McDonald's, O'Reilly Auto, P&G. These are all kind of retail things. The CME, well, there you go. Quest Diagnostics, United Health, Zoetis, Equifax. Really? I thought that they were done for because of that hack. Teradyne, Lam Research. Wait, isn't Teradyne a thing from like from Terminator? And what are you gonna say when they don't raise them? Well, okay, so if something happens between now and then that causes significant risk off or a crash in the market that prevents them from being able to raise rates, then of course we'll know about it well ahead of time, right? But if the economy continues on the current projected track and they don't raise interest rates, then I will be extremely shocked and will have to admit that I'm wrong. I will have to admit that I'm wrong, but I think that the probability of that scenario happening are like zero, basically. There's the only way that the Federal Reserve backs off raising rates is if there's a crash. Because again, and here's the key point that I would stress what we understand about the Federal Reserve thinking right now that is important or is the most recent change, okay? The Federal Reserve believes that the risks to the economy, for primarily future outbreaks of the virus, are inflationary in nature, and therefore they need to raise rates ahead of, they need to, particularly they need to increase the pace of the taper so that they have the option to raise rates in the face of that. Feels good to have your take profit right before a significant move against. Yeah, it does. So they moved quite a bit further. I really could have held out. I could have, it would have been funny if I had canceled my order and moved it up and seen if they would react to that. But because they really didn't want to fill me. Isn't it funny that I took that trade and then after I got out, then all of these other people decided to do something? Because that's, assuming they all got out, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 26, 36, 37, 38. So like 16 orders maybe if they all took profits here on this. Curious. There seems to be some people selling it at 30.5 right now though. So the market maker will in the end probably make money, huh? Just not off of me. Because I got lucky, to be honest. To be honest, there was a bit of luck involved. It's really kind of interesting. You notice here that like there was this really strong move here on the open, but then since then it's just kind of been like chop. Hasn't necessarily been the best trading in the treasury today, has it? And even in the S&P 500, they're actually still right at their opening price, and it's been chopping around this whole time. Well, okay, we got the oil. The oil is going to be important here. What are they looking for on that? The estimate is -1.521 million. They are a draw of 1.521 of crude oil inventory. So we'll see. Ask Paul Volcker if they can raise rates. Yeah. I'm telling you, they're gonna do it. Now that Powell has been left in and everything, you know what that means, right? That means that he can do whatever the fuck he wants. I mean, if he's not going to do whatever the F he wants. He's going to do whatever is appropriate for the economy. And, if rising interest rates is a problem for the politicians or certain companies, then I would recommend not holding those companies. Because I'm pretty confident that we're going to have at least a half a basis or a half of a percentage point rise in interest rates over the next year, if not more. And I'm not quite sure why the average Joe is so convinced that they know better about the future path of interest rates than the Federal Reserve and every market analyst out there. But I'm sticking with the analysts on this one. Analysts can be wrong all the time for sure, but I think they have a good argument here. fixed income market of the world's largest market. They cannot control interest rates, even if people think so. Well, how do you know that? I wonder how do you know that? Because here's the thing is that in order to prove that that is the case, you would have to have a situation where the Federal Reserve really strongly believes that they want to go in a certain direction, and the market disagrees with their direction, and the market disagrees with them, and the market position holds for an extended period of time. And I'm not just talking about a few weeks, I'm talking about like the market holds a price that doesn't make sense compared to the changes in interest rates that the Federal Reserve has made, and it stays that way for like a year or more. Has that ever going to happen? I don't think that's, I really don't see how that could ever happen. So how could you ever prove that the market is actually in control and that what the Federal Reserve says or does doesn't matter? You get what I'm saying? There's this really good argument out there about, so wait, let's focus on oil here for a second. Okay, so the inventories was a much smaller draw than expected. So that should be a buy, right? I don't know how big of a deal that is. So -2.24 versus -1.521. But there's a bunch of different numbers here, right? EIA gasoline inventory is higher than expected. Oh, that's not good. And distillate inventory is higher than expected too. Okay, so overall, it's maybe a negative. Well, let's just see how they sort it out, how far they go on that. So I'm not really... Well, let's see. Can I see it on Forex Factory? Crude oil inventories. That's a relatively mild beat, so... GT350 says crushing build. Is it? I don't know. Like the oil's not reacting that strongly to it, but seems like a negative to me. Maybe it's kind of like a drop in the bucket in the larger picture of things. I don't know. So anyways, there's some good arguments out there about how interest rates should behave based off of what we know about like how money is created and all of these other things. But the problem that I keep seeing with a lot of these theories, in particular this one that like what the Federal Reserve doesn't really matter, and therefore you should take a flattener. I think that's basically the trade, right? So they say, well, the Federal Reserve says doesn't matter. You should just flatten, right? Because they're going to be wrong. It's all based on an unverifiable hypothesis, I don't see how you would ever prove their underlying assumption. Oh, you're just saying Cushing built. I see. You didn't say crushing. I misread that. Well, I mean, they moved from 72 to 71.7 off of that move, and they sold a good 1,500 contracts or so, maybe. So there was a sell off of it. Just, I kind of thought that if there was a build that we would move like $1 or something like that. And that's certainly not the case. Short vol versus long vol. I don't even think that you necessarily need to get the CBOE data for that. If you have Thinkorswim, you can pull up those skew numbers. There's a bunch of different indexes for that. On our platforms, I think I would need special data. I know how I would get that. Lumber bulls are making bank. Is lumber on the rise again? Gosh darn it. I was hoping that by spring the lumber would be back to a reasonable spot so that I could finish my garden. Polish central bank says it may intervene in the forex market. I don't feel too stressed today, but I think I might be starting to smell like I'm a little stressed today. That's just wrong. I'm not going to read that headline. This Bitfinex guy, I want to know. So there was a while ago where Bitfinex on Twitter, he was saying that oh yeah, the reason that I know this stuff is because I did it too. And then after I finished doing it, somebody hired me. A government actually wanted to hire me to actually look at this stuff and things like that. And that's why he knows so much about it. He was an insider. And so I keep thinking, who would that be? Because the only other kind of Ponzi scheme sort of thing that I can think of comparable to Tether would be BitConnect, right? Well, BitConnect did kind of fall apart around the time that the Bitfinex account showed up, So I kind of wonder sometimes. So he's always posting all this stuff. I sure hope nobody asks Sam Bankman-Fried why he does so much business with a known fraudulent stablecoin Tether, which is under criminal investigation for bank fraud and market manipulation. That would be just terrible. And I kind of wonder, okay, where does he get this stuff from? I want a peek into the life of Bitfinex, my boy, because I follow your account quite closely if you're listening, and I just clearly a world that I know nothing about. The insiders of Bitcoin. What are they thinking? What might they do? I have no clue. So I'm not an insider in Bitcoin. And this is why I think that probably it's best to not touch Bitcoin on short-term basis. For short-term trades, intraday trades, probably best to not touch Bitcoin. Oh, by the way, we're having a decent run here in Bitcoin. A decent little run in Bitcoin. Well, I'm back starting about 90 minutes ago. Why is the market so slow? And FTH, it is a little slower than I expected, to be honest with you. I think one thing that might be going on here is that the interest rates have been having a pretty bullish rise here. You realize that we've moved 10 basis points, right? That's how I'm able to get $100. So, that might weigh on equities a little bit. I don't think there's this thing when people say interest rates rise. Okay, there is a certain point at which interest rates really destroys the S&P 500. Okay, but we're not anywhere close to it. 2% on the 10-year will still be just fine. But when it's going up, it is going to have a little bit of a dampening effect on the S&P 500. And we've had pretty big move earlier in this week. So, Wednesday tends to be a time when people allocate a lot of money. I do see some signs. I mean, like the S&P 500 futures are up cumulative delta 30,000. I mean, that's a decent amount. So it seems like there is actually a decent amount of volume going on. They're just not like pushing. The people that bought, they're taking their profits up here maybe, and everybody's just kind of agreeing and trading hands. I don't know. Could be. Even though there was a rally yesterday, the volume was... I did not notice that, actually. You know what, though? It's really hard to tell, like, for the market overall as a whole, what the volume is. You know what I mean? So I saw this. There was this video from this guy that, he's like, I am not giving financial advice. Here's my disclosure. And then he goes on to give, like, financial advice and say, okay, here's what you should buy this and sell this and do this and that. And I'm like, okay, you're so stupid, dude. And, and it's definitely like a marketing thing, And he was saying, oh yeah, this move down on Thanksgiving. Everybody says that it was on low liquidity, but that's not true. Look at the volume. Look at the volume when I look at the SPX. And I was just watching that. I'm like, that's not how it works. Like, that, right? Like, why don't we go and look at the total volume for the entire New York Stock Exchange? That's different. What's the whole volume for like I don't know if there's one that's like all equities volume in the whole world. Is there an index that is all equity volume? That's what you would need, right? So, but we can look at the futures and we can say what is the volume in the futures? They had a decent move yesterday, and it's not any more or less than the days before, it seems to me. So that's kind of hard. But then here's another thing though, is that like being on low volume doesn't necessarily mean what people think it means, right? Like a lot of people think because it happens on low volume, that means that it's more likely to get retraced. And it's not necessarily strictly true. Now, if it's on low volume, then you're more likely to create a liquidity hole behind you and get sucked back into it. But if everybody knows what's going on, right? No market maker is going to market make against a move like that. They're going to pull their orders because like everybody knows that was a good thing or whatever the deal was. Or like everybody knows that the buying is coming in. And so you can get a fast, quick move on very little volume that has very strong, long-lasting impacts simply because of the news, right? So you gotta be careful with that kind of analysis. There you go. So Gary says the Fed is not independent. It works for Congress and is beholden to them. Who wrote the Federal Reserve Act? Congress? Well, okay. Congress could always change the Federal Reserve's what is the word, directive, to no longer be about maximum employment and price stability, and should be more about what Congress wants. Or Congress could write a law where they control the interest rate. But I don't see any of those things happening. No, the Federal Reserve is going to make the decisions that they feel best position them to maintain maximum employment and price stability. And right now, because there is still a virus out there, and apparently the effects of a virus are inflationary because of supply disruptions and so forth, the Federal Reserve feels that in order to maintain price stability, they need to raise interest rates. And when that happens, what is Congress going to do about it? They're going to say, you can't do that because we said not to. The whole point of them being a Federal Reserve is so that can't happen. So what's Powell going to do? He's going to say, pound sand. Be more responsible with the budget. They already say that. I mean, he says that all the time, right? But I think it's a little ridiculous, this expectation that they're going to keep the interest rates low for everybody because the market likes that or Congress likes that. Doesn't work that way. In fact, this move, like the move that they made in 2018, you remember that December of 2018? Okay, that was a policy mistake. That was like, here's everything that we see and the future trajectory of things, and it suggests that we shouldn't raise interest rates right now. I don't think that 2018 had to be like a disaster. I mean, they did end up being okay, but probably they should have pushed that rate increase back 1 or 2 quarters, and then probably we would have been fine. Probably. Okay, but at the time, that's in my intro, when I'm like, well, yeah, but we all think you're crazy. That was when Powell was making that rate increase, right? Like the whole market thought that it was crazy. Okay, that would be one situation, and you guys are all talking like that's the situation now, but it really isn't. Like practically everybody. I do not know of an actual serious analyst that is saying that if we raise interest rates right now, that it would be disastrous. The only person that I see that's saying stuff like that is Zero Hedge, right? Pretty much everybody else thinks that we should be raising rates. And if anything, there are people like I think Ray Dalio that are saying that they should really be more aggressive on raising rates back up. So I really don't understand why this seems to be such a strong sentiment from retail traders. But maybe it's not. Maybe it's just that you guys that think interest rates are going to stay low forever are just really noisy. Did you see 35 million barrels are being bid on from the SPR? Well, I didn't see a news headline or anything about that today. Was there like a specific headline on that today? See, Aaron Cages, he says if they raise rates, they will crash massively. Okay. We'll see. Nah, listen, like whatever Turkey did, I wouldn't put that down as like other countries are going to do that, because what is going on in Turkey is just the absolute insanity. Okay. You've got this guy in power that wants the monetary policy to be a certain way in spite of all evidence showing how absolutely terrible it is. And they're just trying to stem the damage. That watching that unfold, and I don't follow it super closely, so I can't say like he did this and he did this and he did this, right? Because this has been a long saga, right? But just like watching it unravel has just been like really interesting to watch, right? You don't think raising rates will affect the market? I don't think that a 0.5 point increase in the interest rate necessarily has to crash the market all on its own, no. Of course, it affects the market. And, to some extent, the objective there in doing that is to kind of slow the economy down so that you don't get those price rises. But I think that the interest rates that we have are so low that it's leading to excessive market distortions, bad malinvestment. It's kind of, in some respects, creating supply disruptions, particularly in the housing market, and that they need to raise interest rates 0.5%. I think that the market projections and everything are all entirely appropriate. And here's the thing. I think I'm kind of prone to disagree with you guys anyways, because my whole trading career, if we're going to call it that, and going all the way back to 2008, has been some guy on Reddit says, oh, the economy is going to crash. It's, any day now, things are just going to fall apart. The easy money monetary policy that they have right now is like a huge problem. Deflation is not a real thing, and we need to raise interest rates now, or we're going to have hyperinflation, end of the world, right? And then I go and I look at it, and I'm like, nope, that's wrong. I'm going to keep buying. And we had the longest bull market in history, and all of these shitheads that kept yapping on Reddit about shit that they didn't know anything about. And I'm not saying that that's you guys, but this is just like the tendency on the internet. You can understand the tendency on the internet is that there can be bearish markets overall, and that they're going to be contrary to whatever it is the Federal Reserve is doing. If the Federal Reserve is raising interest rates, they're going to say, they're going to ruin the economy if they raise interest rates. And if the Federal Reserve is not raising interest rates, then they're going to say, guys, they're going to create hyperinflation by not raising interest rates. But I have found that the Federal Reserve is actually pretty damn good at what they do. And yeah, they do make mistakes from time to time, but when you actually look at their performance and how, like, the alternatives and everything, it's pretty damn good. And especially when the whole market seems to be in alignment with them, yeah, interest rates are going to rise. Interest rates are going to rise. And anybody that I see coming in here saying that they're not going to rise, my immediate thought is, well, they're one of those people that just ideologically doesn't like the Federal Reserve and opposes whatever they're doing, and they're just really loud about it. Which is you, Air Cages. That is you. I love you, though. Okay, so the Fed has a full employment mandate. When the slack shrinks in the jobs market, the Fed will begin to hike slowly. Yeah, there you go. Now, but what is the risks to that projection, right? So we should think about that. And one risk was, for a long time, and the reason why I think interest rates were staying really high, was one of those risks was that we had another outbreak of the virus, and they had to shut things down again, and that would be deflationary, right? That was a big risk. But then what happened? We got that CPI print. The Biden administration got all uppity about it, and everybody at the Federal Reserve said, oh, wait a second. They looked at the data and they changed, and they said, oh, actually, further shutdowns is inflationary. So that risk went away, okay? The next one would be that the job market doesn't do so well, right? So the employment market is like a pendulum, and right now it's really like very much in favor of the people looking for jobs, and companies are like, their hiring departments are like having a hard time like hiring people quickly enough because their algorithms like filter out too many good candidates and all of these other problems. Okay, but because interest rates are rising, I think what you're likely to see is that more companies start to say, we need to do more with less. We need to pay the people that we have more and keep them and try to reduce our churn. I don't remember who it was that I was seeing, but I saw some people talking about this. I think that they make a good argument that the employment might turn around a little bit. And you could see a situation where some of these people that aren't working, that they don't get back to work for a really long time, and that it becomes a problem. And that might become a risk where market participants start to say that the Federal Reserve should maybe, delay some of their rate increases because of that. So that would be a risk, right? Another risk is that China collapses. If China has to go into full on, well, I don't know. Like right now, it seems kind of beneficial to us. Right now, it seems like the Federal Reserve can raise interest rates and the monetary conditions still stay relatively easy because China is having problems. But if things really got bad in China, it could affect everybody else, and that could certainly be a cause for them to not raise interest rates, right? So that's where I say, like, it would have to be like a pretty significant downturn change in the economy. I think another risk that is out there is the risk of a international conflict. centered around either Ukraine or Taiwan or something like that, right? That's also a risk that I can kind of see we should be in our minds for the next like year, right? Is there anything else? I'm sure that there are other ones. Maybe you guys can think of some. But those are all of those things that I talked about are pretty low probability of happening in the next year, wouldn't you say? So yeah, the market can probably handle the higher rates and they'll adjust accordingly. There are probably some people that are in some stocks that are really highly levered and are going to get absolutely destroyed by higher interest rates. And if you're in one of those stocks, I would recommend not being in them. Because if you're in that, anticipating that the Federal Reserve is not going to raise interest rates, and especially if you're like making the case that like they're gonna go all dovish in the next week, then boy, I think you got some surprises in your future, and that your current course might lead to tears. The Treasury works for Congress as well. Congress spends and Treasury issues to account for the spending. Yeah, I'm smart. Yeah. I think I don't understand enough about what kind of power Janet Yellen actually has. But whatever. So what she does doesn't necessarily directly affect us per se. As much as it is sentiment and where she might direct policy and stuff. 2008 isn't much of a gauge. Of course, they were going to raise rates. They were going to zero. You've shut the world off over the last 2 years, raising rates only to have one effect if done quickly. Yeah, but number one, there was very significant generational deflationary pressures. That was a big problem for them, for starters. Right? Number two, the Federal Reserve really should have started raising rates earlier last cycle. They could have done it. Yellen probably could have raised interest rates once or twice. Could have been a more gradual thing instead of Powell coming in and doing it a bunch of times and then kind of having to backtrack and everything. So I think it's kind of funny. They kind of screwed up both ways. I don't think that there was like their screw ups were like the end of the world, but they kind of screwed up both ways. They raised interest rates too late in the beginning, and then in the end they raised them too late. You know, or they kept going when they shouldn't have, essentially. They made both mistakes. But you know what? I think they're going to get better at it because why? Because we understand now that markets are inelastic. And if we start to factor that into our interest rate policies, we should be able to have much more accurate models about how the market will respond to the interest rate policy, and particularly any kind of quantitative easing, so that you can more appropriately size it. It's a new bottom. Well, I tell you what, the party is over here in the Treasuries. You know what? In the 30-year, really. I mean, at points they seem boring too, but it's crushing today. It's really crushing today. The 30-year is. They've, again, still have quite a ways to go before they're back to the levels from Black Friday. Well, guys, I think today's title is going to be I rant about the Federal Reserve for 3 hours. That's basically what we did, right? Now we're going to say Treasuries crushed after Plan B. How do we say this? Not quite sure what we should say. Now we should say. You've said that before. I'm not 100% sure I believe you. That the euro dollar futures is the best indicator of where rates are now and in the future. Why aren't the bills and options on bills an effective indicator of where rates will be now and in the future over the next year? Wouldn't euro dollar futures have a lot of outside influences based on what Europe is doing, which would be particularly pertinent at the time where there's been concerns about the UK or Germany going into lockdown, right? So I'm not 100%. But then the other thing is show me what the GE is pricing today, so that I can go short it, or long GE is at rates. I think long GE is at rates, but okay. I'm going to point out in this video that it's a slow Wednesday because it's unusual for Wednesday to be kind of like this. Usually a lot of money gets put to work and they move, but I will see you guys tomorrow. In the meantime, stay profitable, friends.